Hello everyone, and welcome back to the channel where we demystify the complex world of how to borrow stocks and short squeezes. Ever wondered what makes a stock so expensive to short, or what it means when the borrowable shares dry up? Today, we're diving deep into fascinating case CLRO Inc., ticker symbol CLRO. We'll break down why this specific stock has appeared on our hard-to-borrow screener with some truly eye-popping numbers. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start with an overview of CLRO Inc., or CLRO. Show CLRO logo/company info on screen. This company operates in the technology and communication equipment sector. It's a microcap with a market capitalization of just $17.07 million. CLRO previously focused on designing, developing, and marketing professional audio conferencing, microphone, and video collaboration solutions. Currently, the company does not have significant operations. It was incorporated in 1983 and is headquartered in Salt Lake City, Utah. What's particularly relevant for us is its estimated float, a tiny 0.7 million shares. Highlight float number. Now, let's look at recent price action for CLRO. Today, the stock is down 21.33%. Over the last 5 trading days, CLRO has dropped 52.31%. However, zoom out to the last 30 days, and it's up a staggering 112.90%. Highlight 30 DAY gain. Looking at volume, today's trading volume sits at 1,681,803 shares, which is relatively low compared to its 30-day average volume of 6,336,150 shares, giving us a relative volume of only 0.3x average today. What is cost to borrow and why it matters? So, what exactly is cost to borrow and why does it matter? Show explanation graphic. When you short a stock, you're essentially borrowing shares from someone else, selling them, and hoping to buy them back later at a lower price. For the privilege of borrowing those shares, you pay a fee. That's the cost to borrow, or CTB. This fee is usually expressed as an annualized percentage. Why does it matter? A high cost to borrow indicates strong demand to short a stock, or, critically, a very limited supply of shares available to be borrowed. When the CTB starts to climb, it signals that short sellers are either desperate to establish new positions or struggling to maintain existing ones because fewer and fewer shares are available. And yes, these fees can easily exceed 100% annually, meaning if you hold a short position for a full year, you could pay more than the stock's value just in fees. Why this stock is hard to borrow right now? Now let's bring it back to CLRO and the astonishing numbers. Show CLRO CTB numbers on screen. Our screener picked up CLRO because its cost to borrow fee is an astronomical 819.5% annualized. Emphasize number, that's one of the highest we've seen. What's more, this isn't a stagnant figure. The CTB momentum for CLRO has soared by 806 percentage points over just the last 5 trading days. This isn't just high, it's rapidly escalating. And here's the kicker, there are currently only 100 shares available to borrow for CLRO. Highlight 100 shares with an estimated float of just 0.7 million shares. This extreme scarcity is incredibly significant. Our internal composite squeeze score for CLRO, which combines CTB level, momentum, shrinking supply, float size, volume/price momentum, and technical setup, is an impressive 82.6 out of 100. These metrics suggest CLRO is a prime candidate for a hard-to-borrow squeeze scenario. However, it's important to be balanced. An extremely high cost to borrow, like CLRO's 819.5%, does not guarantee a short squeeze. It can also indicate that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay these exorbitant fees to stay short, believing the stock will eventually fall far enough to make their trade profitable despite the high costs. Squeeze mechanics explained. So, how exactly does a short squeeze happen? Show animation of squeeze mechanics. Imagine a significant number of short sellers betting against CLRO. As the cost to borrow skyrockets and the available shares to borrow shrink down to just 100 shares in CLRO's case, these short sellers start feeling the pressure. They are paying a huge daily fee, and if the stock price starts to rise, their losses mount rapidly. To close their short positions, they must buy back shares in the open market. This forced buying creates demand, which pushes the price up further. This rising price then triggers more short sellers to cover their positions, leading to a cascade of buy orders. This feedback loop is what we call a short squeeze. For a stock like CLRO, with such a tiny float and practically no shares available to borrow, even a small increase in buying pressure can have an outsized effect. Dilution risk check. One critical factor that can significantly impact a short squeeze thesis is dilution. Show dilution graph. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can provide short sellers with new shares to borrow or cover their positions, effectively offsetting or negating the squeeze pressure even when the cost to borrow is high. So, for CLRO, we ran a dilution risk check. We found no recent dilutive SEC filings such as -1, -3, or 424B forms within the last 90 days. Highlight no dilution. This is a positive sign for any potential squeeze scenario. Additionally, we found no recent reverse split for CLRO in our look-back window, which can sometimes precede dilutive events. Before we continue, a quick but crucial reminder. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For CLRO, given its current hard-to-borrow status, here's what we'd be watching for. First, continued high cost to borrow fees and the continued scarcity of borrowable shares. With only 100 shares available, any further reduction would be extraordinary. Second, watch for a significant increase in trading volume, especially on green days. Today's relative volume of 0.3x average is quite low, so a notable uptick would be a strong indicator of renewed interest recovering. Third, observe the price action for a sustained reversal from the recent declines, particularly the 52.31% drop over the last 5 days. A turnaround could put immense pressure on short sellers. Finally, keep an eye out for any news or catalysts related to CLRO, Inc. Even with limited operations, unexpected news could spark significant interest in a low-float, hard-to-borrow stock like CLRO. CLRO, Inc. CLRO presents a textbook example of an extreme hard-to-borrow situation with an astronomical 819.5% cost to borrow and a mere 100 shares available to short. While these conditions create fertile ground for a potential short squeeze, remember that high cost to borrow does not guarantee a squeeze. It simply tells us that shorting this particular stock is incredibly expensive and difficult right now. It is crucial to conduct your own due diligence and understand all the risks involved before considering any investment decisions. If you found this deep dive into CLRO's hard-to-borrow situation insightful, please hit that like button, subscribe to the channel for more unique analyses, and let us know your thoughts or questions about CLRO in the comments below. Thanks for watching, and we'll see you in the next video.